Welcome to the Deep Dive. Today we are plunging headfirst into, well, one of the most fascinating and fundamentally human topics there is, the psychology of money.
Mm-mm.
This isn't about crunching numbers in a spreadsheet, not really. It's about understanding why we behave the way we do when it comes to finances and why that behavior matters more than almost anything else.
It really does.
They've got some incredible source material here that, honestly, it forces you to question a lot of assumptions.
It certainly does. And the source material doesn't exactly ease you in gently, does it?
No.
It hits you right away with these stark, almost unbelievable contrasting stories that just scream, something else is going on here besides spreadsheets.
Right. You have this anecdote about a high-flying executive, clearly someone who's achieved significant financial success, who in a fit of temper shatters a $500 lamp in a store.
Just smashes it.
And instead of apologizing or, paying reasonably, he pulls out $5,000 in cash, just has it in his pocket, hands it over to the manager, and tells him essentially to get lost. $5,000 for a $500 lamp. That's a particular kind of behavior, what do you say?
Highly irrational by any standard measure of value or cost. Yeah, it speaks to ego, maybe to a sense of being above consequences, a detachment from the actual value of money that most people just can't fathom. And this is a man who, by conventional metrics, was doing incredibly well.
And then on the complete other side of the spectrum, you have the story of Ronald Read.
Ah, yes.
The source describes him as an American philanthropist, investor, janitor, and gas station attendant. Imagine that combination on your Wikipedia page.
It's quite something.
He was a man of truly humble origins from rural Vermont, the first in his family to even finish high school, apparently having to hitchhike 5 miles each way just to get there.
Wow.
He worked these very modest jobs his entire life.
Yet, when Ronald Read passed away, he left behind an astounding $8 million fortune.
$8 million.
And the vast majority of it wasn't for himself. He donated it to his local hospital and library. And the kicker, that high-flying executive who threw money around,
Yeah.
he ended up going broke later in life.
These two stories, pulled right from the source, they just perfectly encapsulate the core premise we're exploring today, don't they?
Absolutely.
Doing well with money has significantly less to do with intelligence or formal education or even your professional success, and overwhelmingly more to do with your behavior.
How you act.
How you act, how you handle it, how you think about it day to day.
And the source makes the crucial and slightly unsettling point that while we can teach people facts or formulas, behavior is surprisingly difficult to teach.
Yeah.
Especially maybe to people who are otherwise brilliant or successful. It's often just deeply ingrained.
We tend to approach money with a mindset borrowed from fields like physics,
Right, like our rules.
We look for universal laws, predictable cause and effect. If interest rates go up, the economy should do X. If inflation is Y, you should do Z.
But money isn't like physics. It doesn't operate according to simple, immutable laws applied to, inanimate objects.
Exactly. The source highlights that unlike, say, healthcare, where scientific consensus on how the human body works has largely replaced old, sometimes dangerous folk wisdom.
Yeah, medicine moves forward globally.
Right. New discoveries benefit everyone relatively quickly. But the world of money investing, personal finance, economics, it's fundamentally different.
It is. It's still so deeply, inextricably tied up with human emotion, individual behavior, subjective goals, personal histories, all that messy stuff.
That's why you see such a massive spectrum of financial outcomes and decisions in the real world, isn't it? Even among people with similar levels of opportunity or intellect.
It's the human element. That's what makes it messy and unpredictable.
So our mission in this deep dive is to take the material you've provided and distill those crucial nuggets of knowledge and insight.
Get to the core ideas.
Yeah. We're going to unpack why we approach money with this physics-like mindset when we should probably be thinking about it more like psychology.
Emotions, nuance.
Exactly. We'll explore how this topic impacts absolutely everyone, regardless of their current financial situation, and look at the powerful, sometimes counterintuitive lessons it offers. Not just about wealth, but about risk, confidence, happiness, and just the fundamental quirks of human behavior.
And for you listening right now, this deep dive is, well, hopefully a bit of a shortcut.
Hmm.
By understanding these core principles from the source material, you can gain a much clearer, more informed perspective on your own financial journey and how the complex world of money truly operates beyond just the numbers.
It's about understanding the why.
Exactly, the why behind the financial world.
Okay, let's jump in then. The source really hammers home this initial idea, how our personal experience, our unique history with money, fundamentally shapes our financial worldview.
This is one of the most powerful foundational insights, I think. There's this massive gulf between knowing what you're supposed to do with money, save more, invest long term, diversify, all of that.
Textbook stuff.
Right. And what actually happens in your head and how you feel when you try to put that knowledge into practice.
Yeah, when fear grips the market or greed makes that speculative investment seem irresistible.
Knowing the textbook answer doesn't always win out, does it?
Yeah.
Your gut takes over.
And as you mentioned, the financial industry is unique in its reliance on this subjective human element. We don't have universal laws like gravity or thermodynamics that govern money.
No, what's rational or logical often depends heavily on the individual perspective.
And that perspective is built on your unique life experience.
Precisely. Everyone alive has lived through a different sequence of economic events under different circumstances at different ages, and what you personally experience with money is vastly more impactful, more compelling.
More real.
Exactly. More likely to dictate your future behavior than anything you might read in a book or hear from someone else.
The source gives such vivid examples to illustrate this. Think about someone who grew up in genuine, grinding poverty, maybe saw their family struggle desperately just to make ends meet. Their fundamental relationship with scarcity, their perception of risk when it comes to holding on to what little they have, or their view of opportunity. It's going to be profoundly different from someone who grew up as the child of a wealthy banker.
Where money was just always there.
Right, where it was never a primary concern, seemed abundant. Even if they later end up in similar financial situations, their internal wiring about money is just different.
Or consider inflation. Someone who grew up in the 1970s or early 80s experiencing double-digit inflation, watching prices spiral upwards, maybe seeing their parents stress about making ends meet or the value of their savings just evaporate.
That sticks with you.
It does. That person carries an emotional understanding of inflation's destructive power. Now, compare them to someone who grew up in the 1990s or 2000s, an era of relatively low, stable inflation.
Which felt normal then.
The first person might constantly worry about purchasing power and be really wary of bonds, while the second might view low inflation as the natural state of the world and barely consider it a major risk. Same economic concept, two completely different internal realities.
The source also contrasts a stockbroker who lived through the utter devastation of the Great Depression.
Unimaginable, really.
Seeing markets evaporate, fortunes vanish overnight. Compare that to a young tech worker in the late 1990s, experiencing the euphoria of the dot-com boom where stocks seem to only go up.
Easy money, right?
One carries the deep psychological scar tissue of financial ruin. The other, the seemingly effortless glow of easy gains. Their views on market volatility, on risk, on the very nature of investing are going to be fundamentally incompatible.
Even if they're both highly intelligent and well-read, their lived experience trumps the theory.
And it's not just generational or class differences. Geography matters too. The source points out an Australian born after 1991 hasn't experienced a recession in their adult life.
That's amazing.
Think about that 30-plus years of uninterrupted economic growth. No American alive today has experienced anything remotely like that.
Not even close.
So that Australian's perception of economic stability, of risk, is grounded in a reality that is utterly foreign to most of the rest of the world.
The consequence of all this personal history is huge then.
Yeah.
It means that equally smart, equally well-informed people can look at the exact same financial data, the same market trends, the same economic forecast, and arrive at wildly different conclusions about what to do.
They're not disagreeing because one is objectively right and one is wrong.
No, they're disagreeing because their individual views are anchored to these vastly different life experiences. Their map of the world is different.
Your own personal encounters with money, your successes, your failures, the economic environment you grew up in, the source, suggests this tiny sliver of world history, maybe representing like a fraction of a percent of total economic data.
Yeah.
Makes up about 80% of how you believe the financial world operates. That personal sample size, as small as it is globally, becomes the dominant filter through which you see everything else.
Wow, 80%. That's huge.
And this isn't just academic. The source makes a critical distinction between intellectual understanding and emotional understanding.
Ah, yes. Knowing versus feeling.
Exactly. You can read countless books, pore over historical data about market crashes, study the numbers of people who lost everything in 1929 or 2008.
You can know the facts.
But that intellectual knowledge will not truly recreate the raw, gut-wrenching power of fear, panic, or uncertainty when it's your money, your future on the line.
Spreadsheets are great for modeling frequency and magnitude, right?
Yeah.
They can tell you how often bear markets happen and how much value is typically lost.
Yeah.
But they cannot capture the feeling of looking at your investment account during a 50% crash and wondering if you've just made a catastrophic mistake that will impact your family's security, your kids' education, your ability to retire.
That pit in your stomach.
That emotional scar tissue, or the lack of it, is a product of lived experience, not data analysis. You have to live through it to really get it on that deep level.
And the research backs this up, doesn't it?
It does. The source highlights a study by Ulrich Malmendier and Stefan Nagel that looked at 50 years of household survey data.
Okay.
They found that individuals' willingness to take on investment risk was not primarily driven by their intelligence, education level, or sophistication.
So not smarts.
Not primarily. Instead, it was overwhelmingly correlated with their personal history of macroeconomic outcomes. Did they experience high inflation? A major recession? Their comfort level with risk was shaped by the dumb luck of when and where they were born, as the researchers put it.
Just dumb luck. Wow. That's a powerful concept. That something as fundamental as your willingness to invest your savings is tied more to your birth year and geography than your MBA or IQ.
It is. Think again about Bill Gross, the legendary bond king. His career really took off during a long period of declining interest rates.
Right.
So bonds seemed like phenomenal wealth-generating machines to him because that's the environment he operated in for decades.
That was his reality.
But for someone whose formative financial years were the inflationary 1970s, bonds might have seemed like guaranteed money losers. Same asset class, opposite perceptions, driven entirely by historical context.
The source uses the inflation example further, too.
Yeah.
Someone entering adulthood in the early 1960s saw consumer prices less than triple over the next 20 years.
Relatively stable.
Yeah. Someone entering adulthood in 1979 saw prices triple in just 12 years, including those painful periods of gas lines and economic turmoil.
Totally different experience.
Is it any wonder these two individuals would have fundamentally different views on inflation and how to protect themselves from it?
Not at all. And even within the same period and generation, experiences vary wildly.
Right.
The source notes that in 2009, during the Great Financial Crisis, the national unemployment rate was around 10%. But for young African-American males without a high school diploma, it was a staggering 49%.
49%.
But for white females over 45 with a college degree, it was only 4%.
Such a disparity.
Different groups experienced vastly different economic realities in the very same year. Their financial worldviews, their trust in institutions, their sense of opportunity would be shaped profoundly by these disparate experiences.
This all leads to one of the source's most insightful points, I think. Every financial decision that a person makes, no matter how bizarre, irrational, or ill-advised it might appear to an outside observer looking at it purely numerically, it makes sense to the person making that decision in that specific moment, given their unique history, information, and emotional state.
The classic example the source dissects is the lottery ticket paradox.
Ah, yes.
Americans spend more money on lottery tickets each year than they do on movies, music, books, and sporting events combined.
That's still staggering to hear.
And crucially, the overwhelming majority of these tickets are bought by low-income individuals. People who statistically have the least amount of discretionary income often can't come up with, say, $400 for an emergency and lack basic savings.
Are spending hundreds, sometimes thousands of dollars a year on something with astronomical odds against them.
Exactly.
To someone who's financially comfortable, who reads finance books and saves for retirement, this behavior seems utterly bewildering. It looks like the definition of irrational.
Why would you blow your limited resources, your potential emergency fund, on something with such tiny odds? It doesn't compute, right?
Right.
But the source urges us to perform an exercise in empathy, to really strain to understand the insider perspective.
Okay.
If you are living paycheck to paycheck, if saving even a small amount feels impossible because expenses consume absolutely everything, if your prospects for significantly higher wages seem limited by circumstance or lack of opportunity,
If you feel stuck.
yeah, if you look around and see others easily affording basic securities and luxuries, nice cars, vacations, health insurance, safe neighborhoods that feel completely out of your reach.
Then buying a lottery ticket isn't just buying a piece of paper with numbers on it.
No, it's buying the only time, maybe all week or all month, that you can hold in your hand a tangible, albeit extremely slim, possibility of escaping that reality.
It's buying hope.
It's buying a moment of hope, a daydream, a shot at getting the good stuff that everyone else seems to have access to. You are, in a very real sense, paying for a dream because you aren't currently living one, and you see no other plausible path to get there.
And while, again, from a purely mathematical perspective, buying lottery tickets is a poor financial decision.
No question.
Understanding the why behind it is crucial. It highlights that rational financial decisions are relative. They are made within a person's unique context, shaped by their history, their aspirations, their perceived lack of other options.
That idea, what you're doing, seems absolutely crazy to me, but I can sort of understand why you might see it differently. That's fundamental to understanding a lot of financial behavior, isn't it?
Definitely. Not just the lottery paradox.
Because financial decisions aren't made in a vacuum, based purely on data.
No, they're made at the kitchen table, in conversations with neighbors, influenced by social media, in company meetings.
All that social context.
Right, where personal history, ego, pride, marketing, the desire for status, and various odd incentives all get scrambled together into a complex personal narrative that dictates action.
And recognizing this deeply personal behavioral foundation is really the first step to understanding why we see the financial outcomes we do, both individually and collectively.
Okay, that makes so much sense. It really shifts the focus.
Hmm.
So, if our personal history biases us, and emotion often trumps calculation, what are some of the fundamental forces or concepts in the world of money that might actually defy our intuition entirely, or at least challenge our modern assumptions?
That takes us into some truly non-obvious territory, and one surprising one, right off the bat, is the relatively recent emergence of retirement as a widespread societal expectation.
That seems counterintuitive, doesn't it?
Mhm.
We plan for retirement our whole lives now. It feels like this ancient, fundamental human goal.
It feels like it, and yet the source makes a powerful case that the entire concept of being entitled to retire from work, to spend your later years pursuing leisure rather than necessity, is incredibly new.
How new?
At most, maybe 2 generations old for a significant portion of the population. Before World War II, for most Americans, the expectation and the reality was simple. You worked until you died or were physically unable to. The labor force participation rate for men over 65 was over 50% right up until the 1940s.
So Social Security was designed to change that, right?
It was, but initially the benefits were minuscule. The very first Social Security check issued in 1940 was for like $22.54.
$92.
Adjusted for inflation, that's about $416 a month today. It provided a bare minimum, not a comfortable retirement.
Hardly living large.
Not at all. It wasn't until the 1980s that the average Social Security check, adjusted for inflation, even exceeded $1,000 a month.
What about pensions? We hear so much about how previous generations all had these guaranteed pensions. The good old days.
That's another common myth the source kind of debunks. While some did, it was far from universal. In 1975, only about a quarter of Americans over 65 received any income from a private pension.
Only a quarter.
And that pension income made up only about 15% of their total household income, on average. The idea of a widespread private pension system supporting a long retirement for most people is just not historically accurate.
So the modern expectation that you are responsible for saving and investing your own money through something like a 401k or an IRA to fund decades of leisure wasn't really a thing until when?
The source puts it squarely in the 1980s. The backbone of today's retirement savings, the 401k, was only established in 1978.
Wow, that late.
And the Roth IRA, a common savings vehicle now, wasn't created until 1998.
1998. That's practically yesterday in financial history terms.
Think about that. These essential tools for modern retirement planning are barely old enough to, well, have a complex financial plan of their own. It really highlights that planning for a multi-decade period of not working is a very recent, maybe even fragile societal experiment.
That's incredible. It completely reframes how we think about this long-term goal. And central to achieving any long-term financial goal, especially one as ambitious as a multi-decade retirement, is the extraordinary, often underestimated power of compounding.
This is perhaps the single most important concept in finance that our brains are just not hardwired to grasp intuitively. It's tricky.
Like the Ice Age example from the source.
Exactly. You don't need some cosmic hammer blow to create massive sheets of ice. You just need a little bit of snow that lasts through the summer.
It built on itself.
Right. That snow reflects sunlight, keeping things slightly cooler the next year, allowing a little more snow to last. Over geological time, those small, consistent accumulations and their reinforcing feedback loop lead to continent-spanning ice sheets.
Applied to money, it means that a small starting base, small, consistent savings, or small but consistent returns can lead to results that seem utterly illogical when viewed through a linear lens.
Our brains are good at calculating 8 plus 8 plus 8.
Simple addition.
But they struggle with 8 by 8 by 8. The exponential growth of compounding is just intuitively hard to appreciate. It doesn't feel right.
And this, according to the source, is the real secret to Warren Buffett's staggering fortune.
It's not just skill.
Well, it's not just that he's an exceptionally skilled investor, which he undeniably is. His primary secret weapon is time.
Just duration.
He has been compounding money successfully since he was literally a child. The source provides the stark math. If Buffett had achieved the exact same annual investment returns he has, but had only started investing in his 30s,
Okay.
his fortune today wouldn't be $84.5 billion. It would be around $11.9 million.
Wait, million, not billion.
Million. That's a 99.9% difference.
That single calculation is just, it's mind-blowing. It makes the point more vividly than any complex chart could.
Totally.
And to underscore it further, they compare him to Jim Simons, the founder of Renaissance Technologies. His hedge fund medallion has reportedly compounded money at an average of 66% per year since 1988.
66%. That's insane.
It's triple Buffett's rate. Yet Simon's net worth is only around $21 billion, far less than Buffett's.
Because he started later.
Exactly. If Simons had somehow been able to apply his 66% rate for the same 70 years Buffett has compounded, the numbers become ridiculously impractical, something like $63 quintillion.
63 quintillion. Just saying it feels absurd.
It is absurd. The point isn't the possibility of those specific numbers, but the sheer scale of the difference that compounding over long periods makes. Even vastly superior annual returns can't catch up to merely good returns applied for a much, much longer time.
We saw this with technology too, right? Like the Bill Gates example.
Yeah. Bill Gates famously questioned in 2004 why anyone would ever need a gigabyte of storage. He was anchored to a linear understanding, completely missing the exponential curve of data storage growth.
You just can't fathom it sometimes.
You can read about exponential growth, but you never truly get accustomed to how quickly things can explode over time when compounding really gets going.
So time is the magic ingredient for compounding. But to get that time, to allow that exponential growth to work, you have to navigate the unpredictable world and, crucially, stay in the game.
Which leads us to another crucial, non-obvious force: survival.
Survive.
If you had to pick one word for what it takes to do well with money over the long run, survival might be it. Making money is one thing. Keeping it over decades, through boom and bust, through personal crises and global pandemics, that's the real challenge.
The source presents some sobering statistics on this, like about 40% of all companies that were successful enough to go public in the U.S. eventually lose almost all their value and are delisted.
40%. Even the successful ones often don't last. Even established businesses are inherently fragile over long enough timescales.
Michael Moritz, the legendary venture capitalist at Sequoia Capital, attributed much of their firm's incredible multi-decade success to a pervasive, almost obsessive fear of going out of business.
Only the paranoid survive.
That's the quote. They operate under the assumption that yesterday's success means nothing for tomorrow and constantly guard against complacency.
This ties directly back to compounding, doesn't it?
Absolutely. Compounding doesn't work its magic overnight. It requires years, decades, sometimes generations of consistent growth.
And for that to happen, your assets, your savings, your plan have to survive the inevitable, unpredictable shocks along the way. Recessions, market crashes, job losses, health crises.
Just staying solvent.
Staying solvent, staying invested, simply surviving the lean times is the prerequisite for the good times to eventually lift you higher.
And this brings us to the non-obvious value of cash.
Ah, yes. Holding a significant amount of cash often feels counterintuitive to someone focused purely on maximizing returns, right?
Yeah. Cash earns very little, often less than inflation. It seems like a drag on performance. It feels like you're losing money just letting it sit there.
Exactly. But the source argues its real value isn't its yield, it's its role in survival.
How so?
If holding cash prevents you from being forced to sell assets like your stocks during a bear market, when prices might be down 30%, 40%, or even more,
Which happened?
then that cash has provided an actual return far higher than its interest rate. It prevented a permanent, potentially ruinous loss.
It saved you from crystallizing those losses.
Right. Preventing just one desperate, ill-timed sale during a panic can be worth more to your lifetime wealth accumulation than picking dozens of winning investments. It keeps you in the game.
It ensures endurance.
Exactly. Compounding isn't about getting the absolute highest possible return every single year. That's unrealistic. It's about achieving merely good returns, maybe 7–10% consistently, but doing so uninterrupted for the longest possible period. Survival is what buys you that uninterrupted time.
And this leads to another profound idea from the source, closely related to survival. The concept of having enough.
Ah, the Heller story.
Yeah, the wonderful anecdote about writer Joseph Heller, famous for Catch-22, being at a party hosted by a billionaire hedge fund manager.
Yeah.
Kurt Vonnegut apparently points out that their host made more money in a single day than Heller had made from his iconic novel over its entire history.
Which must sting a little.
Right. But Heller's response was simple: yes, but I have something he will never have.
Enough.
Enough, that simple, powerful word.
It's perhaps the most challenging financial skill to master, isn't it? Getting the goalpost of your desires and aspirations to stop moving.
So hard in our culture.
The source points to examples like Rajat Gupta, the former CEO of McKinsey, worth $100 million, or Bernie Madoff, clearly wildly successful by any conventional measure.
Both had more than enough.
Both ended up ruined, disgraced, and imprisoned, not because they lacked intelligence or opportunity, but because they couldn't stop. They risked what they had and needed their reputation, their freedom, their existing vast wealth for what they didn't have and absolutely didn't need.
As Warren Buffett is quoted saying about this kind of behavior, to make money they didn't have and didn't need, they risked what they did have and did need. And that's foolish. It is just plain foolish.
Just foolish. The source makes the point that a measurable percentage of people listening will reach a point in their lives where they earn or accumulate enough money to comfortably cover every reasonable need, want, and even many luxuries.
Logically, they should be said.
But the inability to walk away from the table, to say, this is enough, to deny the temptation of another potential dollar, is what eventually leads to ruin for people who should logically be immune to it. The constant pursuit of more opens the door to taking risks that jeopardize everything.
And that connects to the idea that there are things that are never worth risking, no matter the potential financial gain.
Right. The source lists them clearly: your reputation, your freedom, your independence, your family, your friends, your health, being loved, your happiness.
The important stuff.
Knowing when you have enough money is essential for protecting these things, because if you're constantly chasing just a little bit more, you might eventually be tempted to risk the things money can't buy or replace.
Financial success isn't just about accumulation, then.
No, it's about knowing what you're optimizing for. If you're optimizing for enough, you protect the truly valuable things. If you're constantly optimizing only for more, you might inadvertently put them all at risk.
Okay, so we've established that our personal history warps our view. And there are these powerful, non-obvious forces, like compounding and the need for survival that defy intuition. We also know that simply having enough is a crucial but difficult concept. Given that the world is unpredictable and our own minds play tricks on us, how do we even approach planning effectively?
This brings us squarely into navigating uncertainty. The source absolutely agrees that planning is essential. You need goals, savings rates, projections, all that.
You need some kind of map.
But it immediately follows that by delivering a dose of reality. The most important part of any plan is having a plan for when your plan inevitably doesn't go according to plan.
It's the old saying, you plan, God laughs.
Pretty much. Few plans survive their first real contact with the messy, unpredictable world.
We create these beautiful spreadsheets projecting income and returns over 30 or 40 years, assuming a relatively smooth line of progress. But just look back at the last 20 years.
Yeah, it's been wild.
Who predicted 9/11? The housing bubble and bust, the great financial crisis, the fastest stock market recovery ever, a global pandemic that shuts down entire economies.
None of that was on anyone's retirement projection spreadsheet back in 2000.
Not a chance.
A good plan, therefore, isn't one that assumes the future is certain or follows some neat, predictable line. A good plan embraces the unknowns and, critically, builds in substantial room for error.
What does that look like?
Well, a fragile plan requires very specific things to happen for it to work out. A robust plan is designed to be okay, maybe not optimal, but okay even if things go significantly worse than you expect.
Like lower market returns.
Right. Maybe market returns are lower than historical averages. Maybe you lose your job for longer than anticipated. Maybe there's an unexpected health crisis. Room for error is your buffer against all of that uncertainty.
The source also introduces a really counterintuitive idea about progress and destruction.
Ah, yes. That things can gain tremendously over the long run, become hugely successful while being absolute basket cases in the short run, experiencing constant failure and destruction.
Like brain development.
Exactly. A child's brain grows rapidly, but by age 20, you've lost about half of your synaptic connections. Destruction is a normal part of getting smarter, becoming more efficient.
Or Walt Disney's early career.
His first studio went bankrupt. His early films often lost money despite being beloved classics now. Failure was frequent and painful, but it was part of the process that eventually led to this creative empire.
This normality of failure is important because, as we touched on earlier with that 40% statistic,
Most companies don't make it.
right, most individual ventures, most public companies are duds. Most of the market's long-term returns come from a tiny handful of tail events companies that succeed beyond anyone's wildest imagination.
It is normal for most things to fail. If you don't appreciate this fundamental reality, you're likely to overreact and panic when things inevitably go wrong with any individual investment or part of your plan.
This is where the source brings in Napoleon's definition of military genius.
Which is,
the man who can do the average thing when all those around him are going crazy.
applied to investing.
It's simply staying invested, continuing to save and buy regularly, even when the market is crashing and everyone else is panicking and losing their minds.
The source uses that powerful, simplified example over 120 years of market data comparing 3 investors, Sue, Jim, and Tom.
Right. Sue just invests $1 into the market every single month, rain or shine. Simple dollar cost averaging.
Jim tries to time the market, selling everything when a recession starts and buying back in when it ends. Pretty clever, or tries to be.
And Tom is a bit slower, selling 6 months after a recession begins and buying back 6 months after it ends.
So what happens?
Over 120 years, staying invested through roughly 22% of months that were in or near recession, Sue ends up with $435,551.
Okay.
Jim, the quicker timer, ends up with $257,386. And Tom, the slower timer, finishes with just $234,476.
Wow. Just by simply doing the average thing, staying invested consistently through all the chaos, Sue ends up with almost 3/4 more money than the people trying to avoid the destruction.
It shows the power of enduring the inevitable short-term turmoil for the sake of long-term compounding.
It highlights that you can have big failures, can't you? Like Amazon having the Fire Phone flop.
Gold disaster.
As long as they're offset by tail successes like AWS, as George Soros famously said, it's not whether you're right or wrong, but how much money you make when you're right and how much you lose when you're wrong.
So you can be wrong more often than you're right.
And still make a fortune if you manage your downsides effectively and survive long enough for your few big winners to compound.
And managing those downsides, surviving, comes back to that underappreciated concept, room for error.
It's not just a conservative choice. It's a strategic imperative for long-term success in an unpredictable world. Think about card counting in blackjack.
Okay.
Even if the odds are slightly in your favor over many hands, you can't bet your entire bankroll on a single hand, right?
No way.
A string of bad luck, which is statistically probable sometimes, would wipe you out completely. You need enough chips to withstand those swings. Room for error.
So room for error isn't about predicting the future.
No, it's about enduring a wide range of potential futures, even those you haven't imagined. It's your insurance policy against the unknown unknowns.
It's what provides the endurance necessary to let compounding work over time.
Exactly. A practical application suggested in the source for personal finance is to estimate future investment returns at a rate significantly lower than historical averages say, maybe 1/3 lower.
Be conservative in your planning.
Right. Planning for less means you save more. This provides a massive margin of safety. If returns end up being as good as history, great, it feels like a wonderful bonus. But if they are worse, which they might be, you're still okay.
Aiming low adds a kind of psychological felicity if things turn out better. That's a nice way to put it.
And the ultimate enemy of room for error, according to the source, is leverage. Debt.
Taking on too much debt.
Taking on significant debt, whether it's margin debt in a brokerage account or a huge mortgage relative to your income, turns routine risks into potential ruin.
Because you can get wiped out.
Rational optimism might tell you things usually work out, but leverage exposes you to the low probability, high impact chance of being wiped out when things inevitably don't work out in the short term. Those with high leverage in 2008, 2009 were forced to sell assets at the bottom, permanently locking in losses and missing the huge subsequent recovery.
They lost their chance to come back.
This is why the source advocates for a kind of barbelled approach to your money.
Barbelled.
Yeah. One side of the barbell is where you take risks, invest in volatile assets like stocks for long-term growth. The other side, however, should be characterized by extreme conservatism, holding ample cash.
That sounds inconsistent.
It might sound like it, but it's actually a strategy to ensure survival. The cash provides flexibility, independence, and the room for error needed to withstand shocks without being forced to disturb the riskier long-term growth assets.
And that independence is a huge part of it, isn't it?
Massive. Having cash allows you to avoid forced decisions. It gives you the freedom to ride out market downturns, to take time finding a new job if you need to seize an unexpected opportunity that might come along.
The source argues that choosing the happiness and security that comes from having a cash buffer, even if it means sacrificing some theoretical returns on paper,
is perfectly reasonable, even if it's not strictly rational by a simple maximizing formula. Happiness counts.
Which brings us to another major factor in planning: the end of history illusion.
Ah, yes. The idea that we think we're finished products?
Exactly. Psychologists have found that we are remarkably poor at predicting who our future selves will be. We tend to think the person we are today, with our current desires, goals, and priorities, is pretty much who we'll always be.
But that's simply not true, is it? People change. A lot.
Not at all. The source gives examples. The person who chooses a specific college major thinking they'll love that career forever, only to find the daily grind stressful or unfulfilling years later.
Or the lawyer who chases high income through endless hours, then has kids and realizes the cost of childcare, plus the lack of time with family, makes a lower paying, more flexible job infinitely more appealing.
Or the stay-at-home parent who sacrifices current income, only to find later they haven't saved enough for their own retirement and need to re-enter the workforce unexpectedly.
Research cited shows that people from age 18 all the way up to 68 consistently underestimate how much their personality, values, and preferences will change over the next decade.
We just don't see it coming.
This creates a significant conflict in financial planning, doesn't it? How do you create and stick to a long-term plan that relies on consistent savings, consistent investment strategy for compounding, when the person executing that plan, your future self, will likely have different priorities, different needs, and different definitions of happiness?
There's no perfect answer, I guess.
No perfect answer, but the source suggests that one way to navigate this is to avoid extremes in financial planning.
Don't go all in on one path.
Right. Committing to a path of extremely low income for philosophical reasons, Or conversely, chasing maximum possible income at the expense of everything else, your health, relationships, free time, increases the odds of future regret.
Why is that?
The benefits of those extremes tend to wear off as you adapt, but the downsides, not having enough saved later or regretting all the missed time with loved ones, tend to endure.
Endurance through balance seems to be the key here again.
Exactly. Pursuing a path that allows for moderate savings, but also moderate free time, a reasonable commute, time with family building balance into your life at every stage increases the likelihood that you'll be able to stick with your financial plan as your priorities inevitably shift over time. It creates a more resilient life plan.
And tied into this is the idea of sunk costs.
Yes. Letting go of the past. The source quotes psychologist Daniel Kahneman saying he found it easy to abandon past research if it wasn't working because he felt he had no sunk costs.
Don't throw good money after bad, essentially.
Or good time, or good effort. Don't let decisions made by your past self, who was different and had less information, hold your future self hostage. Be willing to abandon plans, career paths, investments, or goals that you've already poured time or money into if they no longer serve the person you're becoming.
The source suggests embracing the ability to abandon old goals without mercy, if necessary, to minimize future regret.
It sounds harsh, but it frees your future self from the potentially poor decisions of a past self who is, in a sense, a stranger to who you are now.
So to plan effectively, you need to plan for failure, build in room for error, and recognize that your own goals are a moving target, making balance and flexibility absolutely key.
Right. And these insights into our behavior and the unpredictable nature of the future help explain how we collectively arrived at our current financial landscape. Which brings us to the role of history.
Okay.
The source gives a fascinating, concise overview of the origins of modern American consumer behavior, starting right after World War II.
The war ended, millions of soldiers came home, the marriage rate spiked, and there was this very real fear of sliding back into the Great Depression.
Understandable fear. Policymakers were actively looking for ways to stimulate the economy and keep demand high.
One deliberate strategy was to keep interest rates low. Initially, this was to make it easier for the government to finance its massive war debt.
But a side effect was that it made borrowing incredibly cheap for returning GIs and their new families to buy homes, cars, and all the goods that factories, which had been making war material, could now churn out.
Consumption became an explicit government-encouraged economic engine.
And this fueled the boom in consumer credit. The first general-purpose credit card didn't even exist until 1950.
That recent, wow.
Interest on consumer debt was tax-deductible. Household debt grew incredibly rapidly in the 1950s. The source notes it grew 1.5 times faster than it did during the infamous debt surge of the 2000s.
Faster than the 2000s bubble.
Yeah. This confluence of factors, pent-up demand from the war, easy credit, and a surge in productivity from technological advancements developed in the 1930s created a massive economic boom.
Factories shifted to producing cars, appliances, consumer goods. People bought houses in the new suburbs and filled them up.
This created enormous numbers of jobs, and crucially, average wages doubled repeatedly from 1940 to 1963.
And during this post-war period, that growth was shared much more widely than it is now, right?
Exactly. The gap between the rich and the poor narrowed significantly, reaching its most compressed point in modern American history. Lifestyles, while not identical, became more leveled out.
People of different classes often drove similar models of cars, had similar appliances in their kitchens, watched the same few TV channels.
You measured your well-being and success against neighbors and colleagues who lived relatively similar lives. Your comparison group was local.
But then, starting around the 1970s and accelerating into the 2000s, the economy shifted. Growth continued, but it became increasingly uneven.
The incomes of the top 1% began growing far, far faster than the incomes of the bottom 99%. It was almost the complete opposite of the post-war flattening.
This led to what the source calls the big stretch.
The big stretch. As incomes for a small group soared, their lifestyles naturally broke away from the average. Mansions, yachts, private jets.
Meanwhile, the rise of media and eventually the internet meant everyone else could see those elevated lifestyles like never before.
Aspirations for the majority inflated rapidly, fueled by this visibility, even though their own incomes weren't keeping pace at all with what they were seeing.
Keeping up with the Joneses transformed from comparing yourself to your equally middle-class neighbor to comparing yourself to lifestyles beamed into your home that were utterly unattainable on average wages.
The predictable result. People stretched. They used the now widely available debt, bigger mortgages, longer car loans, huge student loans to try and maintain the perceived standard of living, the lifestyle they saw others living, even though their own incomes didn't truly support it.
Household debt-to-income ratios soared again.
And the debt burden became increasingly concentrated on lower and middle income groups. Expectations, formed during that unique post-war era of shared prosperity, simply hadn't adjusted to the new reality of increasing inequality.
So history provides vital context for understanding how we got here, how our cultural norms around consumption and debt evolved. But the source offers a crucial caution here.
Which is?
History is a terrible guide to the future. It calibrates our expectations, maybe shows us common human errors, but it is absolutely not a map of what will happen next.
Why not? Why can't we just learn from it?
Because the world changes structurally. The financial tools we have today, the 401k, the Roth IRA, the sophisticated venture capital industry, widespread high-frequency trading are vastly different from even a few decades ago.
The playing field is different.
Exactly. The economy has shifted from primarily industrial to technological and service-based. Old formulas or historical patterns don't necessarily apply because the environment they operated in no longer exists. Recent history is often more relevant than distant history, but even that isn't a perfect predictor.
The source includes that great, slightly meta quote from Michael Batnick on the common phrase, "It's different this time."
Yeah, we usually say that mockingly, right? To dismiss people who think current conditions are unique, implying history always repeats itself.
But, Batnick argues, the 12 most dangerous words in investing are, the 4 most dangerous words in investing are, "It's different this time."
Okay, unpack that.
Because sometimes it is different. The world does change in fundamental ways, and blindly assuming history will repeat exactly is just as dangerous, maybe more so, than thinking everything is brand new.
You need that balance again.
Another critical lesson history teaches us, but one that comes with a steep price, is about market returns.
Okay.
The source reminds us forcefully that getting good returns from investing over the long run isn't free. The price isn't just the dollars you invest, it's paid in volatility, in fear, in doubt, in uncertainty, in regret, in enduring periods where things look absolutely terrible.
It sounds simple on paper. Just buy stocks and hold them for 30 years. But it is profoundly difficult psychologically when the market is crashing, your account value is plummeting, and the news is full of doom and gloom.
That emotional price is the cost of admission. You have to pay it.
Look at companies like Netflix or Monster Beverage. They've delivered absolutely staggering returns over their lifetimes, turning small investments into fortunes.
Life-changing money for some.
But the source points out that both stocks spend something like 95% of days trading below their previous all-time high.
95%. So if you owned them, you were experiencing pain or at least discomfort and doubt most of the time.
That volatility, that emotional roller coaster is the fee you pay for the potential long-term gains. It's not a bug, it's a feature.
You have choices, the source suggests. You can pay the fee, accept the volatility as the cost of entry.
All right.
You can opt for a lower return asset with less volatility, like a savings account or maybe a used car. You pay a price, lower return for more certainty.
Or the dangerous option.
You can try the equivalent of Grand Theft Auto. Try to get the high returns without paying the volatility fee, usually through market timing or clever accounting tricks.
Trying to get something for nothing.
And trying to avoid the fee, however, almost always costs double in the long run. The source gives examples like GE under Jack Welch, where earnings were aggressively smoothed with accounting maneuvers to give shareholders the illusion of stable, non-volatile growth.
They didn't pay the volatility price up front.
But the bill came due later in the form of massive losses when the truth eventually emerged. Fannie Mae and Freddie Mac did similar things before 2008. Trying to bypass the natural cost of high returns inevitably leads to greater pain later.
The powerful insight here is to view market volatility and uncertainty, not as a fine. You've been unfairly charged and should try to avoid at all costs.
But as the necessary admission fee for accessing the incredible magic of compounding returns over the long term.
If you accept it as the price of the ride, You're much more likely to stay in your seat through the inevitable bumps and actually benefit from the destination.
Understanding financial bubbles also requires this kind of nuance, doesn't it? The source argues that bubbles aren't always purely irrational manias.
How so?
Often they involve different people playing different games with different time horizons. Someone with a very short time horizon, a day trader or a momentum investor, might see an asset like Yahoo in 1999 skyrocketing.
Even if the long-term valuation is absurd.
Right. They might rationally decide to buy in because they believe it will go up more in the next week or month. Their goal isn't long-term value, it's short-term momentum. They plan to sell to someone else quickly.
And the games people play influence each other. Short-term traders can drive prices up, attracting attention from longer-term investors, and vice versa.
This also extends to consumer spending. Much of our spending is socially influenced. We see what others have, the car, the house, the clothes, and feel pressure or desire to match it, often because we want to be liked or admired or just feel normal.
But we only see the output, the spending.
Exactly. We don't see the input or the process. We don't see their goals, their anxieties, their debts, or the price they are paying. Maybe they're working 80 hours a week. Maybe they're drowning in credit card debt.
Comparing your own spending and lifestyle to others without understanding their full context, their game, and the price they're paying is a fast track to disappointment.
Or stretching yourself dangerously thin for a lifestyle that doesn't actually fit your goals or income.
Finally, the source explores the compelling nature of pessimism versus optimism. It argues that in finance, pessimism often sounds smarter, more sophisticated, and is far more common than optimism.
Even though optimism tends to be the more realistic stance over long timescales, history generally trends upwards, despite setbacks.
True optimism, as defined by the source, isn't believing everything will be great all the time. That's naive.
No. It's the belief that the odds of a good outcome are in your favor over time despite inevitable setbacks. It's grounded in the simple, quiet reality that most people wake up each day trying to make things a little bit better for themselves and their families.
Being a serious possibilist. I like that term.
Pessimism sounds smart for several reasons, though. Money is universal, so bad financial news grabs everyone's attention immediately. It feels urgent.
And announcing that things will get worse, that the market will crash, that the economy is doomed, often makes the speaker sound wise and cautious, like a sage warning the naive optimists.
As John Stuart Mill noted, the man who despairs when others hope is often admired as a sage. It sounds more profound.
And setbacks, crashes, and tragedies are fast, visible, and easy to construct a compelling narrative around. A bank collapsing, a market plummeting, these happen quickly and are dramatic events ripe for storytelling.
Progress, on the other hand, is slow, compounding, and often goes unnoticed. You don't see overnight miracles like sustained GDP growth or global poverty reduction. It happens gradually over years and decades.
It's much harder to write a gripping headline or a compelling book about gradual improvement than about sudden collapse. Good news is boring news sometimes.
But pessimism often overlooks a powerful counterforce. Threats incentivize solutions.
How does that work?
The source uses the example of peak oil predictions after the 2008 financial crisis. Pessimists looked at declining oil discoveries and rising demand and extrapolated a future of scarcity and soaring prices. Doom was inevitable.
I remember that.
What they missed was the innovation, like fracking technology, that those high prices incentivized, leading to a massive increase in supply that completely overturned the predicted trend.
Human ingenuity kicked in.
Assuming ugly stays ugly is easy, but it often ignores human adaptability and invention.
Consider the alien over NYC analogy again from the source. In 2007, New York City was a hub of commerce and innovation.
Peak finance almost.
In 2009, after the financial crisis, the physical city was the same, the infrastructure was still there, the talented people were still there, the tangible capacity of the economy was arguably similar or even better.
Yet the city and the whole economy was reeling from the worst hit in 80 years. It wasn't physical destruction, it was vicious narrative damage.
A collapse of confidence.
Trust, belief, that froze the economy. This highlights that in high-stakes, low-information situations, people are incredibly vulnerable to believing powerful narratives, even if they are flawed or based on limited information.
Quack medicine thrives during a plague. Highly sophisticated investors fell for Bernie Madoff's relatively simple fraud.
The high stakes in investing the potential for life-changing wealth make people pay attention to low probability, fearful predictions just in case. This is yet another reason why having room for error, flexibility, and independence is so crucial.
It acts as a hedge.
A hedge against being forced into desperate decisions or being vulnerable to harmful narratives simply because you lack the buffer to wait them out or think clearly.
So history gives us context, helps calibrate expectations, shows us recurring human tendencies, but it's definitely not a crystal ball for the future because the world evolves.
And navigating that evolving world requires accepting the inherent price of worthwhile pursuits like investing. It's not supposed to be easy all the time.
This has been a deep dive indeed, covering so much ground about how our minds and the world interact when it comes to money. Let's try and pull it all together into some key, actionable lessons you can take away from this source material.
Absolutely. Based on everything we've discussed from the source, here are some core principles to maybe keep in mind for your own financial life. First, go with less ego.
Humility is key.
Yeah. Accept the significant role of luck and risk in financial outcomes, both your own and others. Recognize that not all success is due to skill, and not all failure is due to laziness or stupidity.
Focus on what you can control.
Your effort, your behavior, your savings rate, your exposure to risk. And choose your financial role models carefully. Look for broad, repeatable patterns of behavior like consistency and patience, not just extreme outliers whose fortunes might be heavily influenced by rare luck or perfect timing.
Second, less ego actually leads to more wealth.
How so?
The source defines saving money as essentially the gap between your ego, your desire to spend money now to signal status or get instant gratification, and your income. Wealth, in this context, isn't just about having a high income. It's built by consciously suppressing what you could buy today in order to gain more in the future, whether that's more stuff or, more powerfully, more options and flexibility.
So no matter how high your income, you simply will not build wealth if you can't put a lid on present gratification driven by ego or external pressures. You spend it all.
Third, just save. Save money.
As simple as that.
The source argues you don't always need a specific, predefined goal, like a down payment on a house or a retirement age set in stone today to start saving.
Interesting.
Saving money without a defined purpose is one of the most powerful financial actions you can take. It acts as a crucial hedge against life's inevitable, unpredictable surprises and challenges.
It provides flexibility, options, and peace of mind for the unknown future, which is arguably more valuable than saving for a single static goal that might change anyway.
Fourth, understand and be willing to pay the cost of success.
The admission fee.
Exactly. Any worthwhile financial goal, particularly long-term investing returns, isn't free. The price isn't just the dollars you invest, it's the psychological and emotional cost enduring volatility, uncertainty, doubt, and regret.
Don't view these as penalties, fines that you should desperately try to avoid. See them as the necessary fees, admission fees, for accessing something valuable in return, like the power of compounding.
Trying to get the returns without paying the fee almost always costs you double later on.
Fifth, worship room for error. Build a buffer into your financial life.
Margin of safety.
Could be in the form of cash savings, a flexible lifestyle, or simply having lower expectations for short-term returns. This margin of safety between what could happen in the unpredictable world and what needs to happen for you to be okay is your most powerful protective force.
It ensures endurance.
Which is the foundation upon which compounding can work its long-term magic. It looks conservative on the surface, but it protects you from things you can't possibly foresee. It's anti-fragile in a way.
Sixth, avoid the extreme ends of financial decisions.
Because you change.
Right. Recognize that who you are, your goals, and your priorities will change significantly over the course of your life. Committing to extreme financial paths, like dedicating your entire life to maximizing income at the expense of everything else, or planning for a life with minimal income and no buffer, increases the likelihood of future regret as your priorities inevitably evolve.
Pursuing balance at every stage, moderate savings, reasonable work hours, time for relationships and hobbies makes it much more likely you'll stick with a plan and avoid locking your future self into decisions made by a past self with different goals.
Seventh, be willing to abandon sunk costs.
Let go. Don't let decisions made by your past self, who had different information and priorities, trap your future self. Be prepared to walk away without mercy from plans, investments, or even career paths you've already invested significant time, money, or effort into.
If they no longer serve who you are becoming or the goals you now have.
Letting go of the past is essential for moving forward without regret. It's hard, but necessary sometimes.
And finally, focus relentlessly on independence.
This feels like the big one.
The source highlights this as the ultimate dividend money pays, and perhaps the single most powerful financial goal: the ability to control your own time.
Having the financial flexibility to do what you want, when you want, with who you want, for as long as you want.
This isn't necessarily about being a billionaire. It's about having enough and the buffer of savings and flexibility to call your own shots.
Getting the goalpost of lifestyle desires to stop moving is key to building the savings and achieving the independence that enables this.
Sometimes making a decision that feels reasonable because it gives you independence and happiness is far more valuable than a decision that might look strictly rational on a spreadsheet but leaves you feeling trapped or insecure. Choose happy over right sometimes.
These lessons truly drive home the core idea, don't they? Mastering money isn't really about complex formulas or predicting the future. It's about understanding and managing your own behavior, recognizing the powerful forces of psychology and history at play, and focusing on the timeless principles of patience, survival, and knowing what truly constitutes enough for a life well lived.
Rather than just a balance sheet that looks good on paper.
It certainly adds a whole new dimension to thinking about finances. It makes it feel less like cold math and more like navigating the complex, fascinating landscape of being human.
It puts the person back into personal finance.
Well said.
Absolutely. So as you reflect on everything we've discussed, the way your own history shapes your views, the power of compounding over time, the need for survival and room for error, the fact that your future self will likely be different from who you are today, and that reasonable often isn't strictly rational. Consider this. What financial decision that might seem completely right or optimal based on the numbers or conventional wisdom today could potentially become unreasonable or even a source of significant regret for a future version of you?
Yeah, that's a question worth pondering deeply.
Indeed. Thanks for joining us for this deep dive into the psychology of money.